Used unwisely, debt can be extremely stressful. Used wisely, debt can be relatively stress-free. The stress of debt comes from having to work hard to pay off the loan. However, by limiting your investment to properties that generate enough cash flow to pay off the mortgage and cover all of the expenses, this stress largely disappears. It is the tenant who pays off the loan and not you. This is the strategy I recommend, only investing in cash flow positive properties. This, to a large extent, limits an enormous amount of stress. To demonstrate my point, let's take a look at two hypothetical people, Sam and John, investing at the worst possible time, right at the peak of the housing bubble in 2008, just before the bursting of the US real estate market. Like many people, Sam purchased real estate hoping it would go up in value and making rich. Banking on that capital growth of his newly acquired piece of property, he thought nothing of the fact that the rent received from his tenant did not cover his mortgage repayments and all of the expenses of the property. Each month, Sam went to work and he earned money to pay for a house that he wasn't even living in the hope it would go up in value. Sam understood his sacrifice and he was willing to make it for the chance to own a property in the hopes it would be rising quickly in value. Sam was taking a definite loss for a maybe profit. I call this real estate speculating, not investing. When the bubble popped, he calculated that paying thousands of dollars month in and month out, hoping one day it would rise in value to where he made a profit, was too stressful and unwise. He quite rightly cut his losses and just walked away. Some of Sam's friends lost their jobs and walking away wasn't even a choice. They were forced to walk away, losing a lot of money and time in the process. In 2008, the real estate speculators got hosed. It was a very stressful time for Sam. Compare that to John, who purchased properties where the rent covered all of the mortgage and costs associated with the property, and even put some money into his pocket. Now, John was under no such stress. The rent continued to come in and put money into his pocket every single month, which was a bonus because the company John worked for was unable to offer him as much overtime work since the crisis. In fact, with so many foreclosures and evictions of property speculators, rents actually went up. With very little stress, John enjoyed the cash flow return on his investment over the next few years as the real estate market rebounded, and eventually John had capital growth as well as his cash flow returns. John thought, if real estate investing is this easy and rewarding when I buy at the worst possible time, imagine how good it could be if I put in a bit more research and bought at the best time. In 2008, although speculators got hosed, investors made money. The purpose of this story is to convey that by leveraging other people's money, you can put your wealth creation plan into hyperdrive and do so in a way that is largely stress-free. I want to talk about a side note here for a moment. We live in a world of fiat currency. If we lived in a world of sound money, then it would be very realistic to save for your retirement and even save your way to wealth. Unfortunately, we do not live in those times. Since the reserve currency of the world, the United States dollar, came off the gold standard in 1971, we live in a world where money is debt, and debt is money. Trying to work hard and save your way to wealth is simply not a realistic option for most people anymore. All over the world, the gap between rich and poor is growing, and I believe in large part there are two primary causes. The first is increased taxation, and the second is inflation. The growing gap between rich and poor is because the poor and middle class have not adjusted their wealth building strategies to allow for these two facts. When you save, you already pay close to 50% of your income in taxes just to be able to keep what is ever left after expenses. Then you put your savings in a bank account where you are taxed again, year after year, by what I call the inflation tax. Inflation destroys the value of your savings because the government prints more and more money. Year by year, bit by bit, your savings can buy less and less. So there are no tax benefits to saving. You can only save with after-tax money, and when you do save, inflation tax continues to eat it away until it's all gone. Now that is not very financially intelligent. It should also not be a very big surprise that the tax code works against savers. Sadly, the incorrect economic theory of Keynesianism is the accepted line of thinking in the governments in the Western world. Keynesian theory suggests that when there is an economic downturn, people stop spending, which drags down the economy even further, which in turn causes a further contraction of the economy and an economic death spiral. The solution, according to Keynesianism, is to stimulate spending and punish savings. I won't go into why this line of thinking is incorrect here, but what is important for you to know is that if you are trying to save yourself to wealth, your government is actively working against you and punishing you at every turn. Perhaps you might want to swim with the tide for a change and get rich in a way that the government will support you.